Unraveling the Markets, a deep dive into efficient market hypothesis versus behavioral finance. Introduction. The efficient market hypothesis, EMH, and behavioral finance stand as two pillars in the world of financial theory, each offering distinct perspectives on how markets operate. At first glance, they appear to be opposing forces, with the EMH advocating for the rationality and efficiency of markets, while behavioral finance explores the influence of psychological biases and behavioral heuristics on market behavior. However, a closer examination reveals a nuanced interplay between these two seemingly contradictory theories, as they coexist in shaping the complex dynamics of financial markets. Efficient market hypothesis, EMH, developed by Eugene Fama in the 1960s, posits that financial markets are inherently efficient, incorporating all available information into asset prices. According to EMH, it is simply impossible for investors to consistently achieve above-average returns by analyzing past information or exploiting market trends because prices instantly adjust to new information, leaving no room for profitable opportunities. Three forms of EMH exist: weak, semi-strong, and strong. A. The weak form of EMH. The weak form suggests that past prices and volumes are already reflected in current prices, rendering technical analysis futile. B. The semi-strong form of EMH. The semi-strong form extends on the weak form by asserting that all publicly available information is already incorporated into asset prices, making fundamental analysis equally ineffective. C. The strong form of EMH. The strong form of EMH contends that even insider information cannot be exploited for abnormal returns, as it too is swiftly reflected in prices. Proponents of EMH argue that the market is a powerful information processing machine, efficiently reflecting the collective wisdom of all participants. This hypothesis has significant implications for investors and investment strategies, leading some to favor passive investment approaches like index funds, where the goal is to just match the broader market's performance rather than beat it. Behavioral finance, in contrast to EMH, behavioral finance introduces a human element to market dynamics by acknowledging that market participants are not always rational. This field, pioneered by researchers like Daniel Kahneman and Amos Tversky, explores how psychological biases and mental shortcuts and heuristics can lead investors to make irrational decisions, creating market inefficiencies and hence opportunities to outperform the market. Behavioral finance identifies various cognitive biases, such as overconfidence, loss aversion, and herd mentality, that influence decision-making. For instance, the tendency of investors to sell winning stocks too early due to overconfidence in their abilities and the fear of losses is a manifestation of behavioral biases. This branch of finance recognizes that individuals may deviate from perfectly rational behavior, leading to the formation of bubbles, panics, and herding behavior. Understanding these psychological tendencies is crucial for explaining anomalies that challenge the assumptions of EMH. The interplay between EMH and behavioral finance. While EMH and behavioral finance are often portrayed as adversaries, a more nuanced perspective recognizes that they can coexist in different degrees within the same market. Markets may exhibit varying levels of efficiency, influenced by factors such as the type of information available, market participants' behavior, and the prevalence of institutional investors. In certain situations, markets may reflect a high degree of efficiency, especially when information is readily available and participants are rational in their decision-making. However, during times of uncertainty, fear, or exuberance, behavioral biases can take center stage, leading to deviations from rational expectations. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. Here comes the adaptive market hypothesis, AMH, which was proposed by Andrew Lo, in his book, Adaptive Markets: Financial Evolution at the Speed of Thought, where he attempts to reconcile these two theories. AMH suggests that market efficiency is not a constant, it evolves over time as participants adapt to changing conditions. In this framework, markets can be both efficient and inefficient at different points in time, depending on the prevailing circumstances. Real-world examples. Examining real-world events provides insights into the interplay between EMH and behavioral finance. The dot-com bubble of the late 1990s and the subsequent crash exemplify how irrational exuberance and herd behavior can lead to market inefficiencies. During this period, investors exhibited overconfidence in the growth potential of internet-related stocks, driving prices to unsustainable levels. Similarly, the 2008 financial crisis showcased how behavioral factors, such as excessive risk-taking and herding among financial institutions, contributed to the collapse of the housing market and the subsequent global economic downturn. During these times, EMH struggled to explain the severity of the crisis, as it assumed rational behavior and efficient market mechanisms. Implications for investors. Understanding the interplay between EMH and behavioral finance has profound implications for investors. While EMH suggests that beating the market consistently is a challenging task, behavioral finance provides insights into potential opportunities arising from the irrational behavior of market participants. The financial markets have seen legends like Warren Buffett, Peter Lynch, Charlie Munger, and our very own Rakesh Jhunjhunwala who have beaten markets consistently over long periods of time by taking advantage of market excesses and behavior anomalies. Investors can adopt a balanced approach, incorporating aspects of both theories into their decision-making processes. Recognizing the limits of market efficiency, they can utilize fundamental analysis and quantitative methods to identify mispriced securities. Simultaneously, an awareness of behavioral biases can help investors navigate periods of market irrationality, avoiding herd behavior and emotional decision-making. Conclusion. To conclude, investors, armed with insights from both EMH and behavioral finance, can navigate the complex landscape of financial markets far more efficiently. By understanding the limitations of market efficiency and recognizing the influence of behavioral biases, investors can develop more robust investment strategies that capture opportunities, as and when they arise, and also help in mitigating portfolio risks and reap benefits of long-term compounding of wealth, in this ever-evolving financial ecosystem. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you. Stay tuned for next video.